Dan Lacalle is with us, Chief Economist for Tressis Gestion. Happy New Year.
Happy New Year to you too.
Thanks so much for coming in. Let's just pick up on this Chinese inflation data. What do you think it tells us?
It tells us that the slowdown of the Chinese economy is much bigger than what we initially expected last year. We have seen industrial production, consumer confidence. We have seen many different leading indicators showing to this point. And obviously, another factor that it's showing is that the yuan devaluation has hurt the economy more than what consensus expected. Actually expected that the yuan would have helped the economy. It's actually done the opposite.
So great, rub your hands.
Exactly.
The Chinese government is going to step in with huge liquidity injections.
Absolutely.
Or,
as always.
Or aren't they?
Absolutely they will.
I mean, they are trying at this point to deleverage, over-leverage parts of the state-connected industries.
Yeah.
So why would they want to reliquefy and provide easy credit to the economy when that's going to go into the wrong pockets?
Well, you see, these are the contradictory messages that we always get from China. On one side, you hear that the government is committed to deleveraging. On the other side, you have massive liquidity injections, rate cuts, yuan devaluation. An economy that is growing at 6.5% with 3% unemployment, with 3%, with very low inflation, is not an economy in which you inject trillions of yuan and need a devaluation and rate cuts. So no, the Chinese economy cannot grow and deleverage at the same time. It needs 4 times more debt today to create a unit of GDP than 10 years ago. So the government needs to choose. The government needs to choose between sustainable growth, which is closer to 4%, not 6.5%, rather than...
You've answered my question. Actually, but I'm going to ask it anyway. Where is the sustainable level of growth? Because there seems to be a panic every time we see a lower bit of fixed asset investment in China, when we see lower spending in China, the inflation data, etc., across the board, the data is weaker. But by Western standards, by developed market standards, they are all pretty much great figures in many cases.
Exactly.
So we're now at between 6.5 and 7 on the overall GDP figure, on the official statistics. And we have official statistics, in inverted comments, on a lot of countries. I'm not picking on the Chinese here as well. But as they become a developed nation, and they are a developed nation in many, many ways as well, 6 handle is unsustainable, isn't it? But then people start talking to me about the social consequences and the problems there on the contract with the people from the government if we get below 6. So between 4 and 6, are we in a very torrid area? Does that become a non-soft landing?
Well, that is the problem, is that the Chinese economy, 4% growth for the Chinese economy is the equivalent of recession for the OECD economies. Why? Because there's so much overcapacity that has been built in the last 10 years, so much debt that requires this sort of running to standstill strategy of getting more debt in order to sustain businesses that are underperforming. And that makes it very, very difficult for the economy to go back to normalized levels of growth and at the same time improve its productivity and its leverage. So, but the sustainable level, the Chinese government needs to understand this, is that the sustainable level is much closer to 4, and that soldiering on with the idea that the economy needs to grow at 6.5% is going to create further damages and more intense ones in the future.
They only have to look to 1997 to see the evidence, don't they?
Exactly. Absolutely.
Can I take you to the stock market? We are trading around 2014 levels on the Shanghai Composite. It's been quite an extraordinary pullback from the highs that we had on this index right back in 2015, the real height that you saw, that big spike like a mountain. But since then, we've come right back to fairly low 2014 handles. How do you trade China? Because clearly there's still pockets of wealth. There is a growth story still around some areas, whether it's luxury or consumption. There was a story this week from the ministry saying they want to encourage more purchases of household goods, including cars. So would you trade it via China, or would you be looking at China proxies, whether it's through a luxury European company or through an American international company if trade gets resolved?
Yeah, the Shanghai Composite is the index that is always cheap. And it is an index that always looks optically cheap, just a little bit like Russia, to be fairly honest. Why? Because the biggest components of the Shanghai Composite don't generate returns above their cost of capital and never do, even with all the consensus estimates. Therefore, the best way to trade the improvement in the new economy in China, the best way to trade the things that are actually improving, and many of them are, is via luxury goods companies. Australia obviously is a key way of investing into the Chinese growth without the Chinese risk, and basically try to avoid the state-owned enterprises, try to avoid the very large conglomerates. That's it's not an easy index to trade from a long-only perspective. Because, as I said, it looks always cheap, but it's cheap for a reason.
Fabulous. Loads of interesting points already. Thank you so much indeed for that. Dan, a lot of analysis, already massive column inches. We tried to read as much as we could as well, but they can be patient. They're now watching the risks, which have become, a quote from the Federal Reserve minutes, more pronounced as well. And we know there's this content about when we have the next rate hike as well. And one of them, I think, even said, let's remove forward guidance and just work on the data itself as well. So the market and the president got what they want so far. What happens next?
What happens next is disappointment, because it's not about rates, it's about liquidity. And all this discussion about whether the Fed is going to delay rate hikes is not avoiding the fact that spreads are going to continue to widen, because risk is happening, because the growth expectations, earnings expectations, cash flow expectations in general are disappointing. That is the key factor. So you're not going to see an increasing money supply, an increasing private credit coming just because rate hikes are going to be delayed. It's not happening. And that is the problem, is that we're not paying attention. We're talking about rate hikes as a problem. The Fed continues to be behind the curve. The Fed continues to be extremely accommodative. That's not the issue. The issue is liquidity.
Once upon a time, we would have said there are two legs to this story. One, what you do on monetary. Two, what you do on fiscal.
Exactly.
But fiscal flushes are busts, so to speak, in many ways as well. We've already had the fiscal stimulus out of the United States when it wasn't needed. Now might have been actually maybe a more apt time in 2019 as well. So I ask you, will there be a fiscal response anywhere? Because all we seem to be doing around this desk these days, because we've been conditioned since QE, is to talk about the monetary response.
I don't think that there's fiscal space in the large economies. There is no fiscal space. We might...
What are you talking about? We're only at 90 to 100% debt to GDP.
Only.
Yeah. The Japanese got themselves up to 230.
Exactly.
There's a model there somewhere.
There is a model that takes you to stagnation. The Japanese model takes you to stagnation. So in terms of fiscal policy, there is very little that can be done. There is a lot that can be done in terms of improving disposable income of the middle class. There is a lot that can be done about reducing demand-side policies, but that is not what governments present themselves to do. What they present themselves to do is to increase fiscal stimuli and obviously depend on very low rates and high liquidity. But debt saturation is what's happening. What is happening right now is that we have exceeded the path in which a little bit more of debt generated a little bit more of growth. Is that each new unit of debt is creating less growth, less productivity growth, salaries don't increase as much as inflation, discontent, people don't spend, it's a perverse incentive.
No one in the marketplace has been talking about stagflation as long as Jeff Cutmore, so perhaps he should be the next head of the ECB. But we have a big change, of course, coming later on this year, and it's hard to see Mario Draghi being happy handing over a mandate when you've got effectively stagflation happening across the Eurozone if that plays out. So what do you think the task is going to be for the next head of the ECB, and what do you expect them to do?
But the next head of the ECB is going to have an incredibly difficult position, because on one side he's going to find himself with a massive stimulus. The ECB balance sheet is 41% of GDP of the Eurozone. Interest rates are at zero. Excess liquidity, 1.8 trillion euros. It's insane. So he or she will not be able to come up and say, look, we're going to inject more liquidity, do more TLTROs. Everything has been done. And the Eurozone this year is likely to grow 1%, not 1.6%. The Eurozone is showing the evidence that all of these programs have not delivered the type of growth, because the problem is structural. The problem is a massive level of government spending, very high taxation, and obviously demographics. And central banks don't print growth. Therefore, the next one is going to have to normalize. And he is going to have to normalize in a kind of, I would say Jean-Claude Trichet had to do, in a way in which he knows that there will be negative consequences, but maintaining the current policy is going to leave it without any type of tools.
What about countries like Germany that do have some fiscal headroom at this point? If this European experiment is to work, those countries do need to begin spending more, don't they, to stimulate? I mean, is there the possibility that twin track with the ECB taking more action, that we do see a new policy from Germany that involves higher government spending?
Yeah, the German government has already tried it. It stopped its austerity program. It started increasing public spending, but you cannot solve the Eurozone situation by bringing Germany to do the mistakes that Spain, Italy, France or Portugal do. It's ridiculous. You have to get the Eurozone to do things correctly, not everyone do things incorrectly. There is no evidence that Germany is spending less than what they need, investing less than what they need, or consuming less than what they need. The evidence is that the rest are still spending way above their means, and that's what is not changing in the Eurozone. The Eurozone has put government spending at the forefront.
Got to leave it there. You're competing with that great sound which says we're going to break.
You knew that there could be a major announcement that would shift totally people's perceptions of risk through the first part of the year. Do you think you could keep it to yourself? I mean, that's the question. You
look at allowed to trade.
Look at the Trump administration over the last 2 years, and it's leaked like a sieve, really. And every time there's been the threshold of a breakthrough on a major deal, we've learnt about it. Now, some comments here from the Chinese Commerce Ministry. Trade talks with the US lasted long because both sides were serious and honest. The ministry says topics of the talks with the US included trade and structural issues. And that's as far as the tease lasts. And we are all waiting for this big announcement that we told would be made at some point, possibly today. But we've had no leak, as far as I can ascertain, from either the Chinese or the American side coming up to this so-called big announcement.
Because there isn't a deal, is that what you're saying?
Well, and so that raises some interesting questions about why the European session and why the Asian session. Well, Europe looks like it's going to be weak. Asia has been lackluster, to say the least, off the back of the inflation data. Yeah. And we've kind of framed a narrative around the inflation data, but has it been weak because there is no deal?
Well, I think that the deal in itself is not going to be a catalyst. What they are going to agree on are margins on a much wider problem, which is that the cycle, both of the US and the Chinese economy, is slowing down. And the deal is not going to change that. It's just going to be margins on things that obviously will be positive, but they're not going to change the trend. That is what I think is the problem, is that we're talking all the time about 2018 as if the problem had been no deal between China and the US, and it's taken us away from the other more important problem, which is simply that the cycle is turning.
Yeah. Stop agreeing with us. Excellent, thank you, Daniel. Well, I think this gets tricky as well, because back in 2011, when I looked at the G20 communique in Cannes under Sarkozy, the Germans are accused as much as the Chinese of having the wrong trade policies for a balanced global economy. So the Germans can pick on the Chinese on IP potentially as well, but then the Americans will still pick on the Germans, especially if they've cleared the deal with the Chinese as well, because of the trade surplus the Germans have with the Americans as well. So that's a long-standing bugbear. So maybe there's a bit of bait and switch here, learning from Mr. Trump. Have a go at that one over there and hope that you're enemy's enemy is your friend, or whichever way around it goes.
Absolutely, and that's what they have done. Not as aggressively as with China, but the U.S. administration has been talking about the unfair trade situation with Germany. And obviously would be the next one to be, let's say, there as a target. Because the problem here is that for many, many years in the United States, you have seen massive complaints in the World Trade Organization on the protectionism of the European Union, which disguises protectionism under safety and environmental issues, and in terms of China, because there's no separation of powers, because of property rights and legal rights protections. And what is happening is that that is unsolvable. The way that the World Trade Organization is set up today is impossible to solve that situation. Even more importantly is that it's impossible to get to a deal that would please the US, because you're not going to revert the trade surplus that those countries have. The US is a net importer for those countries and will likely continue to be. You don't buy in the US BMWs because there's unfair competition from the Germans. You buy them because you like them.
The Europeans are going to have to choose, though, at some point, would appear to be the direction of travel. Do they align themselves with the Americans and President Trump and accept that there's going to be a hard road on trade negotiation going forward? Or do they accept the assurances that they're getting from Beijing around technology transfer, energy and other issues that Europeans have concerns about? And do they throw their hat in with the coming power rather than the superpower that seems to be fatigued?
They would rather do the latter, no, and decide to side with China because it's closer a model than compared with the European Union. The European Union is a more directed interventionist model, similar to the Chinese, and therefore it's easier to agree because it's from a political perspective. You don't have to deal like the U.S. administration with hundreds and hundreds of companies with different strategies, no? But they can't. And the reason why they can't is because you cannot offset the sales to the United States with larger sales to China, even in your most optimistic views about growth of the Chinese economy.
Just look at the numbers. 30% of total EU trade is with China, between Europe and China. How would a fight play out? I mean, these comments are coming through the wires today early on from BDI, the German industry group, who's looking to table a paper, and they've come up with effectively about 54 demands to Berlin and Brussels to try and push back against China. How would a fight between Europe and China play out versus, say, the United States one? Would it be much more civil, much more diplomatic and much quieter behind the scenes?
It would be much quieter but much more damaging, because the Eurozone just simply cannot rely on its internal demand, on its internal market. The US can. The US is a massive market, and that's why everybody's exporting to it. However, the Eurozone needs exporting outside. Therefore, you would have a probably much quieter, much more diplomatic, maybe more, let's say, under the radar type of negotiation, but much more damaging in terms of trade growth, because the Eurozone cannot say, okay, we can take a tough stance on this situation with China, because they don't have the internal demand. It doesn't have the demographics, the structure of the economy that the United States has.
Because the Germans won't spend up like the Americans.
Not because the Germans don't spend up. It's because you cannot fight demographics. I'm sorry to repeat this.
The Germans don't spend.
Huh?
The
Germans spend what
I'm not
they
going to go
want.
at them. I think they're probably right, but they I think their savings ratio is about 4 times what the UK is at the moment.
Well, but that doesn't mean that the Germans are bad spenders. Is that the UK is very indebted. So this is the problem. Is that every time that we talk about balance, we try to make the countries that are doing well behave badly. That's not the solution, and that is not going to help. We were talking about it in the break. If you get the Germans to spend twice what they're doing right now in order to boost exports from the south of Europe, you're going to to reach an 0.1%, 1.2% of Eurozone growth. That is not the solution. The solution is not to build white elephants in Germany. The solution is to stop building white elephants in France and in Spain.
Customer is being more cautious than ever, and that it's a very challenging market. And yes, there's only so much money to go around, unfortunately. So, and we're seeing that with the likes of Devon.
If I hear every year since almost probably 2011 that the customer is more and more cautious, it's not that the customer is more and more cautious; it's that they're overly optimistic.
The retailers.
The retailers.
Well, and maybe because those who are investing in.
Every year, the customer. They're blaming on the customer for having a consumer pattern that is different to what they expect, is because every year for 8 years they have got it wrong.
Well, I would suggest it's no harm for them to be optimistic about maybe what the customer's going to do. But in the last quarter, we've seen the level of political uncertainty has been such that it's been very, very difficult for retailers, especially when it comes to big ticket items, because it's so easy to hold off on some of those investments in the home. So why not wait and see how things are going to transpire and whether or not your job's going to be secure in the longer term.
Patrick, thank you very much for joining us today. Patrick O'Brien, UK Retail Research Director, Global Data. We are counting you down to the start of the session, so we're looking forward to the reactions in the retail space to the numbers crossing today. We'll be right back after this. Discussing this, so what Amazon wins at all costs, Dan?
Exactly. So when you think about the valuation, we have seen these stocks, I wouldn't say derate, but definitely underperform in an environment in which top-line growth continued to be decent, but margin pressure started to creep up. What happens when top-line growth disappears?
Well, I think that's where you see the multiple correction, and that's very much what drove the profit warning in Q4.
Do you think that consensus has already embedded the downgrades of estimates that it should to be confident about EPS for 2019?
Well, I think so, and as ever with markets, my view is you probably saw a slight overreaction to results. And actually ASOS is up almost 30% from its lows, which were as little as 2 weeks ago.
31% year to date. You've done really well for 2019.
Guys, come on, guys. This is a terrible, terrible, terrible stock for an investor who is looking for a consistent performance. This was a 77. Let me put this in context. You talk about it's up 31% year to date.
No, I know. Laugh, you cry about this stock.
It was just step back. All right, all of you in there in investor land. It was a 77 quid stock. 77 pounds. When was this? 31st of March. It was a 77 quid stock. Then it was a 21 pound stock on the 21st of December. So you've gone from 77 quid to 21 quid in 9 months as well, and you're telling people they should get involved in this one. Well, I find that really hard to believe, Marcus.
Well, I think that's the opportunity. I mean, it's easier to be bullish on the stock at 21 pounds than at 77 pounds. And
so what is the correct? The multiple is it's trading 46 times forward. How do you value this stock? Whether it should be at 20 times forward, 46 times forward that it's currently trading, or 150 times forward, as I'm sure it has been over the last year or so? How do you? What is the right value for this company?
Well, absolutely. When a business is growing at the growth rates that ASOS is, even in the challenging environment...
Say is or was?
Is. So they've downgraded growth from 20 to 25% corridor CAGR, which they should and probably will achieve over a 5-year period. This year will be high teens, which actually in a market where growth is rather subdued, is still not disastrous. The multiple has more than halved, and expectations in the stock are actually now relatively low. So I would argue this is probably a time when pessimism is far higher than it has been for a number of years, expectations are lower, and growth might have come off a bit, but actually, long term, the dynamics still look very strong.
So it's an upgrade story. So it's the company is downplaying estimates?
No, I think they've gone through a very challenging period, and you will see a period of weakness, but actually have the structural issues that we like for the stock, have they fundamentally changed over the long term? I would argue not hugely.
Marcus, Dan, we'll pick up the conversation.
Yeah, absolutely.
It's a disaster.
And it's going to get worse because the only way in which you could offset that impact would have been if the Chinese growth in sales would have been strong. However, if you saw the latest data of auto sales and what the car industry was mentioning about sales in China for 2019, it's actually very, very poor. We're talking flat sales for next year.
But it's nothing to do with Brexit. The UK business minister, Mr. Clark here, says this second, he's just said, literally fresh off the wire, he said Jaguar Land Rover clear that adding further costs from no-deal Brexit would be against its interests. Mr. Clark, it's nothing to do with Brexit. It's because your government and previous governments and Mr. Khan and Mr. Johnson as well, let's be apolitical about this, have changed the rules on what these companies are allowed to sell in the United Kingdom without it being punitive on a tax front for drivers.
Brexit is going to be a tremendous excuse for earnings misses this year, like Trump and the trade war was for last year. It's the excuse. It's the external enemy that's the best friend of man.
But let me make a market point about this and bring Marcus back into the conversation. What's the new news here? And if you look at auto valuations across Europe, they reflect a deep discount because of all of the issues that Steve has mentioned here, plus add to that concerns over a trade deal with the United States and sales to China slowing. My question would be then, as we look at earnings expectations for Europe, roughly in the sort of 10% ballpark for 2019, but earnings having grown at possibly half the rate in Europe vis-a-vis the rest of the world since the 2009 low, what is the prospect for an improvement in those expectations this year rather than us having another rotten year for earnings growth?
Yeah, well, I think it's always relative to expectations. And as you say, the market is now, consensus is now expecting roughly 9.5% earnings for 2019. In my view, that's still far too high. That probably needs to come down by half. But actually, sensible consensus has probably moved ahead of that. And where we stand now is quite an interesting stage in the cycle, because some of the more early cyclical names are actually rebounding on quite weak results. And that's an indication that you've seen the share prices move ahead of earnings expectations. And we might be reaching that inflection point where the degree of bearishness in these sectors is to such an extent that people are beginning to move back into them.
So profits in Europe could outperform the United States at this point, because what are we looking at? 6.9% for 2019 profit growth for US companies. So the 9 handle here in Europe is better.
If that can be achieved. And my view is that probably still needs to come down. And analysts have an amazing ability to start the year at 10% and then work their way down. And that's what we've seen in Europe.
Even if it's equal, even if it's in the same realm, it's quite a different story to 2018, where you had a big breakout in US earnings well above that 20% level.
Absolutely, and that's part of the attraction of Europe at this stage in the cycle, that you have Europe on a meaningful discount, and as the US begins to slow down, admittedly from very, very high levels, to a growth level more in line with Europe, actually there the risk reward looks slightly more interesting.
Dan's hating this.
I'm going to disagree so profoundly. Europe is untouchable. You just mentioned, and absolutely right, that you still have a 50% downgrade to forward estimates, 5-0. On top of that, you have European elections that are going to show a massive increase in populist results, unfortunately. On top of that, you have not slowdown. You have growth estimates for the Eurozone coming down. But on top of that, if you look at the indices in Europe, you have the vast majority of the big stocks have bought most of their growth in earnings outside of the Eurozone, in Latin America, in many countries, and they're very dependent on inflationary signals. So they're very exposed to Latin America, very exposed to commodities, etc. Very hard to get excited. You cannot find it very easy, while at the same time, the ECB has stopped purchasing the new supply of net financing needs of countries. And therefore, what you have as well is credit spreads rising.
Let's get Marcus back. You've got 15 seconds.
Yeah, well, I think you're absolutely right. Growth is decelerating globally, and Europe isn't immune from that. But actually, as a stock picker, the exciting part of Europe is you've seen the whole market derate significantly. And in my view, in places that's been overdone, which creates opportunities for us as long-term investors.
Mark, Willem, thank you very much indeed for that. Daniel, just a quick one from you would be welcome here. Is the fact that we're not seeing a great deal of movement around sterling Is that because the market has already priced in a defeat for Theresa May next week? And if we get that extension that Willem is talking about, would that be positive or negative for sterling in your opinion?
In my opinion, the sterling already discounts no-deal Brexit. Almost, I wouldn't say the worst scenario, but definitely the most uncertain one. And the fact, actually not what the sterling has done, but what the gilts have done, how gilts have strengthened, particularly last year, also shows that the concerns of the market are less on a no-deal Brexit than on a delay. And I think that is probably what we're going to see. And obviously, I don't think that unless we have some kind of a black swan type of situation, which I think is very, very unlikely, because both the European Union and the UK government have grounds of flexibility. Although, of course, they're going to say that this is it and that nothing can be changed. That is ridiculous. Of course it can. The European Union is changing its terms every day, all the time. So what I think is that both the sterling and the UK 10-year are already reflecting, let's say, the worst of the four scenarios that we're talking for Brexit.
Dan, thank you. It seems like everyone's been in Poland this week. Jen?
But that is exactly, let's say, the most likely risk, isn't it? Because on one side, the Eurozone has rejected to make strict, measures in terms of the non-performing loans. The non-performing loan problem remains very, very elevated, and particularly in Italy as well. And the market capitalization is virtually impossible, because who is going to underwrite an equity raise in this environment, while the Eurozone slowdown is pretty evident?
Well, the non-performing loan problem has been addressed very aggressively by a number of banks, particularly the big ones. This specific bank has a much larger problem than the others. Effectively, if you take the non-performing loans net of provisioning, it is 1.5 the capital of the bank. Exactly. So again, it's a lot. Okay, it's a lot. So it's a specific problem for this bank. Now, what's going to happen again? There is already subordinated that can be transformed into equity, and that would be probably enough to recapitalize the bank and solve the issue for the time being. It won't be an easy solution, but it's there. And again, the big issue is whether the overall economic situation in Italy evolves in a positive way, or the situation deteriorates. Again, in the second case, you should expect other problems in other banks. Otherwise, it's a limited problem linked to this specific lender, which has been problematic for a while.
But this is.
Absolutely. If you remember, we were talking about it before, if you remember, forecasts expected that the UK would be the weakest growing economy in 2019 compared with the Eurozone countries. That is actually reversed completely. And now what we have is, on one side, we have Germany showing 1 quarter already of contraction. The industrial production figures, the European economic sentiment that came out yesterday was also very poor. Now industrial production in France, obviously they're going to blame it on the weather or on the Gilets jaunes, you name it. But the reality is that this has been an undoing that has been going on for a while. The Eurozone has been posting net negative economic data for at least, that I'm thinking of, 12 months. So the entire last year and at the beginning of this year. So we are going to see much larger downgrades to growth for the main Eurozone economies.
Only last year it felt as though France was the great ray of hope, that if Macron could manage to deliver his project, reform at home, reform abroad, then you might have some confidence around the Eurozone. Now, some of that hope seems to have faded given what's happened with many of the partners around Europe, the Germans namely. We've had a fracturing in the coalition, and then domestic problems at home that he can't seem to solve. There's no way out of the solution. So how negative is it for psychology, sentiment around Europe, that France cannot seem to make any progress?
It is negative for sentiment, it was very predictable. We talked about it here, that it was very, very unlikely that Macron would deliver on the reforms that he was promising, because we had seen it in the past. We saw it with Sarkozy. We saw it in many occasions. So, but it is.
The protests morphed. They weren't just unions. They were.
I agree.
They were different. They were. This
I agree.
Mob of people that didn't have a real leader.
I agree, and the reality has been extremely disappointing. The polls show very low support for Macron, but I think that the underlying problem remains that the Eurozone has completely abandoned all structural reforms and bet everything on monetary policy. And monetary policy stopped working in terms of delivering growth.
You've had your 2 hours, that's it, my friend.
That's it.
Thank you very much. Glad you went right to the end. Tomorrow is Giles Keating as guest host from Werfstein Institute. We'll all be here.